Good evening, everyone. Very warm welcome to all of you. And thank you for joining us today for Decoding Budget 2026 session. I'm Krishna Venetti and I'm hosting this today's session on behalf of Sailotech. Just a quick introduction before we begin. Sailotech is a digital transformation company focused on helping organizations improve efficiency through technology, automation, and modern enterprise solutions. And one of our key offerings is iCapture and AI-powered intelligent document processing solutions. This is our fourth consecutive year hosting this initiative in collaboration with data advisors and expert speakers to decode the union budget and simplify its implications for business and investors. Coming to today's session, since the Union Budget 2026 was announced yesterday, so this webinar is designed to help you understand the key takeaways and the real impact. It gives me great pleasure now to introduce our speakers for today's session. Mr. Vineet sir, co-founder and managing partner at Data Advisors. So he'll take us through the economic survey glimpse and the key budget 2026 announcements. And next we have Jairaj sir, Director General at the CIMEI, who will share us an industry overview on the broader direction of the budget. And also we also have Mr. Aditya Surana, Managing Director, so who will decode the direct tax proposals and the key takeaways. And finally, Mr. Ajay Suresh Kedia, founder and director at Kedia Advisory, so who will share us insights on the impact of budget 2026 on the capital markets and the investment outlook. Now request Vinit sir to begin the session. Over to you, sir.
Thanks, Krishna. Thank you so much and welcome everyone for today's session. And Krishna, I will request you to mute all
Yes,
people
yes, I'm
except
doing that.
speakers
I'm
so
doing
that there
that.
is no carry. Krishna, can you do the needful? I'm sharing my document. As we all know, this is the second budget of this new government, and they have termed this budget as a Yuva Shakti Atmanirbhar budget. Complete budget, all initiatives and all are purely for Make in India and complying on the three kartavyas, starting with the sustainable economic growth, capacity building, and Sabka Saath, Sabka Vishwas. All the initiative and the proposals of direct tax, indirect tax, or we see from a key policy, key incentives, key initiative, whatever declared in this budget are all surrounding these three kartavyas, which we will discuss in detail having deep dive. Obviously, the objective was the fiscal consolidation to be continued, but what we have seen, it is happening at a very crawl stage, very slow pace. Stock market behaved yesterday very differently, mainly due to the STT, Security Transaction Tax. But today we have seen it all changed, and today it was in positive. This budget does not have any freebie, does not have any key announcement, whether for individuals, corporates, apart from changes on the direct tax and other part. For the reforms perspective, mainly from the Make in India and other part. So because freebies are mostly in the first and last budget, which we seen last year, it happened already. Lots of investment opportunities have been created in the new emerging sectors. We can see like data center, AI, GCC, semiconductor, nuclear power, and other sunrise sector. By announcing tax proposals in direct tax and indirect tax, new incentive schemes, multiple incentive schemes now already running at multiple ministry. Now new scheme will come into picture, which we will discuss in detail, and ease of doing business is again a major objective in all this. What we can say in short, the complete budget focuses less on the short-term stimulus and more on building durable economic foundations. To start with, if we can see the economic survey. Economic survey is mainly given that blessing that yes, we will continue having the good GDP growth rate. This year we are looking around 6.5 to 7, and next year it may continue seeing. Inflation will be under control. We will be the emerging and fast growing major economy. They requested and pushed government to concentrate on making India and PLI schemes, which government has done. Yes, they all are not PLI, but on different schemes, which we will discuss and all. Highest capex allotment, infra-led growth is happening. Concept and service export was a major part. Initiative combining of the private public contribution to have made a digital public infra so that we have multiplier growth on all aspect and having the inclusive growth, which is the Sabka Saath, Sabka Vishwas. On budget, which we just now, because it's a Yuva Shakti budget, completely all things are three kartavyas. And we will see how this each and every kartavya, which are the initiatives, how it is implicating, having implication on you or the organization will have, which we will discuss in detail. Obviously, being a fiscal consolidation was the objective. No major subsidies like urea subsidy or other subsidies was given here. And main ease of doing business has been taken into consideration, either from a direct tax or from indirect tax, covering customs, GST, and all. So before we go into direct tax proposal, I will request my colleague, Mr. Jairaj Srinivas, who is the Director General at SIME. That association is mainly concentrating on electronics industry. But yes, we would like to know the complete industry overview from MSME, from electronics and other sectors. Over to you, Jairaj. Jairaj, you need to unmute. Minty, can you unmute Mr. Jairaj?
Yeah. Now. Yeah, good afternoon, everybody, and thank you, Vinit ji, for giving an overview of this current budget. See, actually, on February 1st, no, when Nirmala Sitharaman has presented the budget, as you said rightly, there are three kartavyas she is talking. See, what we see the industry reaction is one is, this is giving a boost to the electronic manufacturing, that is component manufacturing. And they have increased the outlay from 29,200 crores to 40,200 crores for the FY27. This is aimed to sustain the momentum of the manufacturing. And Government of India also want to launch ISM 2.2, wherein they are targeting the areas, the eastern part of the country, particularly the Odisha and Assam, where the IS semiconductor mission will take this thing. And the targeted incentive of, the proposal of 15% safe harbor cost for the foreign data center is is a very positive move, but it is a long term, and government is talking till 2046.
Jairaj, we are not able to hear you.
You are not able to hear me. Are you?
We can hear you. Can hear you.
Sorry?
Now we can hear you, sir.
We can hear you, sir.
Okay. Now, when the government is talking about the data center, which is targeted for 2047, it's a long-term plan for the government, and we sure that it will work out. But the component of localization and the supply chain, which government is very often they're talking about a last mile delivery. We are not very sure, because when the people are importing the CKD and SKD, see the passive components are coming as a part of the CKD. So how is that government going to tackle the supply chain? Because when everything is coming in as a CKD, so that government has to tell us. And the following the announcement of market announcement of the shares of EMS firms will be surged up to 6%, reflecting the positive market sentiment. But once again, it will help only the large companies, just like Dixon and Sirma and all. And government is also talking about a DLI. Of course, it is a very good move. India has always been, India has always been known for what do you call the design area. India, it has been a king for the design area. But it was the design hub was there in Bangalore. But for some reason they have moved out of Bangalore. But I hope that they are targeting once again the eastern part of the country. I hope that it will work. So this is how the industry look at the the increase creating a 10,000 crores for the MSME. I'm not very sure because never this particular thing, the PLI or DLI has worked so far. It has always been, helping the large companies, and the government has to look into that in that area, particularly when they are making Udyam as a MSME, and traders are also becoming an MSME. So most of the time, the benefit goes to the trader, and the manufacturer doesn't get any benefit out of it. So this is how what industry look into this particular area. So next, I think the experts can tell us that how the industry is going to act on this. Over to you, Vinit.
Thanks, Jayaraji, for sharing insight how the industry is looking this budget and what all still expectations are there, which they would like to fulfill. Now, before we start the direct tax proposal, there's some technical issue coming to Aditya. I will start on the indirect tax proposal, and then we will discuss on the direct tax proposal. And after that, we will discuss on the capital market views from Ajay Suresh Kedia ji on that part. So let me again share the screen. My screen visible?
Yes, yes, it is.
Yeah, the slides are moving, Binti.
Yes, it is moving.
Yes, it
Okay,
is
thank
moving.
you. So we will do in two parts from indirect tax proposal. First on GST. If we see the changes under GST are most like a implementation of the announcement which was made in the GST 2.0 in last September. Only that part has been changed in the bill. Otherwise, major changes are done in the customs. To start with GST, there was obviously an issue where any discounts given in the sales as a post supply, there was a connection with the valuation rules, and always you should have a prior agreement or agreement at the time of giving the discount. That condition has now been removed, and now only if a credit note has been issued for any discount given, irrespective whether you have agreement or not, and respective credit has been reversed by the recipient, then it will be complied with. So it's again a good reform because there were major litigation where there were disallowance of the credit, disallowance of the discounts, which is having the paying the dual time taxes even on this discount part and impacting the all the whether FMCG, FMCG or any other sector, which have this tendency where they give discounts after or during the sales. Coming to the next point, a good relief for industry, again from the GST 2.0 announcement, where currently the provisional refund, which is given around 90% within a week from the filing of application, is allowed only for geo-rated exports, which is covering physical export and supplied to SEZ. After this change, this provisional refund provision is also applicable to inverted duty structure. The IDS structure is where the output tax rate is lower than input rate. Mostly government has tried to remove that IDS structure in number of sectors, but still it prevails. So wherever it prevails, now you can apply IDS refunds and you can claim for provisional refund of 90%. Similar like to zero rated export and SEZ. A major relief which is being announced here. Coming to next part, It's more about if you've seen in the month of January, they have announced about post office exports. It's a major boost for all the small consignments going there, where you can do it from post office now. Complete regulation came into picture and all. In line with that, now even under GST, earlier up to 1,000 rupees of refund, I cannot go and ask. Maybe 1,000 rupees is very low for government, but not for a individual taxpayers. Because it matters, it reduces the cost of the product and it make me more competitive in the international market. Considering that now because e-commerce is also a major boost, government has removed that threshold limit. So even a 1 rupee, you can go and claim refund from the government. A good move for again a export oriented industry. This is completely a like adjustment where till now a national appellate authority for advanced ruling, which is a higher authority. Whenever advanced ruling appellate have a different view, you can go to national level authority. Till now not came into existence. Recently, GSTAT, Goods and Service Tax Appellate Tribunal came into existence. And that authority now has been given the equivalent authority for the National Appellate Authority for Advanced Ruling, called NAR also. So now anyone would like to apply for NAR, they can go to GSTAT also and take the benefit. Now GSTAT have multiple benches across states and they've started hearings also. So it's good time to now apply in such cases where your authority for advanced ruling at appellate was not in line with what you were looking into. Again, this issue came from GST 2.0. Intermediary service is like more like a agency services where you provide service on behalf of others. The place of supply for intermediary was location of service provider, not the location of service, which is very common POS rules. So what government has done, they have implemented now by changing and removing relevant provision and saying the general rule will apply even for a intermediary services. So for any exports now, earlier intermediary exports are liable to GST. Now it will not be. The major beneficiary, even the gift city, where the number of banking or NBFC or financial partners are working there. Reverse will be for imports. Earlier imports were not liable to GST, but now it will be liable. Now question came because multiple litigation are already going on in multiple industry, whether this provision has been changed retrospective or prospective. Currently, the change is announced prospective, and we look very rare chance where it will be retrospectively implemented. So in that case, again, some people will ask and claim for refunds on exports and other aspect. Maybe government may put a restriction. Generally, they do, but we do not know whether government will change or not. These were all the GST changes which we come to the all indirect tax changes from customs. We have seen in last 5 years around 8 FTA signed, and mother of all deals, EU FTA signed last week itself, where we have seen 99% products of India will get benefit. But there was a concern about carbon tax, which still open point in this EU FTA, which government tried in this budget by bringing some new scheme called CCUS, which we will discuss in detail, to remove the impact if tomorrow any carbon tax is imposed under treaty. Now we come to the key changes under customs. The major change which happened is for the concept called AEO. It's called an authorized economic operator. It's a WCO World Customs Organization concept which India implemented in 2011. It's allowed to all the inbound, outbound movement of goods for exporters, importers, or combination of both, where they can take multiple supply chain benefit being an AEO, whether tier 1, tier 2, tier 3. Now, what change government has done here? They have extended the deferment period. So here, deferment of payment of tax is allowed. Currently, is a fortnight. From 1st to 15th, you pay on 17th. From 16 to 28, 29, 31st, you pay by next second. Now that fortnightly became monthly. Just imagine, same like your GST. Now you will pay customs duty monthly, not on the average shipment. Today, what happens on every shipment you clear, you file your TR6 challan or you pay through electronic cash ledger, again increasing compliance and cost. Here, what will happen? Your payment will now be monthly. It's again a major initiative taken by the government. And first time AAO is even announced in the budget speech also, which is a really rare case. Even they have told to custom authority for cargo clearance, give them more leverage apart from what we're giving now, so that more and more people come and become an AEO. Third major changes here, apart from an AEO, if you are a manufacturer importer and you come under an eligible category, same like your PSU, which has been called APU, Authorized Public Undertakings, you can get a deferment benefit apart from other benefits which will not receive to you, which will be available to only AEU. It's a good time for all importers, exporters who are whether into manufacturing or trading, they can apply for AEO. Government will decide who will be the eligible manufacturer importer apart from AEO. If you're falling in that, you can apply in date same like APU and can get the benefit. Here, more major changes, instead of penalty, if you're paying under voluntary compliance, they pay the fee part. So you're paying some charges for non-payment of duty and making your issue closed. So accordingly, they made the relevant changes under the provisions to provide that relief to all the stakeholders. Again, a good move from ease of doing business, which is again a major initiative of this budget. Advanced ruling under customs is valid for 3 years. Now, what they've done, now all advanced ruling issued after this provision has been come into existence will be 5 years. Further, if any existing advanced ruling judgment is coming till this law is implemented, you can request authority to give validity of 5 years instead of 3 years. Good move, because nowadays, if there is a law sustainability is there, when I can understand that whatever I've taken advanced ruling will sustain for 3 or 5 years. It's always good from my side where we can do planning for my procurement, whether I'm a trader or importer or other scenarios. This budget has again given one more benefit for a bonded warehouse. One benefit is given under income tax, which Aditya will brief, where they are giving allowance where the supplier of capital goods under bonded manufacturing for contract manufacturing, a toll manufacturing concept, will have a exemption from income tax. I will not go in detail because that's the area of Aditya who will provide deep dive. From customs perspective, today, for every movement from one warehouse to another, bonded warehouse, I need to take a permission. But after this change, I do not need any permission. It's like a self-assessment. I will know what goods I am moving, at which date and all. That have again a major booster because it will reduce the transaction cost and also simplifies the operational compliance. If anyone is combining a AEO plus bonded warehouse, it's a good move where you're getting a extended working capital benefit and other benefit from both schemes. I think this benefit is purely for a fishing industry, all the coastal areas, wherever the fishing is the major bread and butter for the people. Now, if any vessel with the Indian flag is going in the exclusive economic zone or high seas beyond the 12 nautical mile definition of India, and they are doing any fishing there, if they bring back, it will be considered as within India goods and liable to normal duty. From there, suppose they supply to any other vessel or to Sri Lanka or nearby any coastal other countries, that will be considered export. So objective is to extend the definition of India for customs, where even any Indian flagging vessel goes in the exclusive economic zone or high sea, doing the fishing is part of definition of India. Second, a fishing industry will have a major boost where they are going in that area, taking away some fish and all, bringing to India. It will be consumed into India. If you are doing exports to countries like Sri Lanka or other nearby countries, it will be considered exports, reducing the my logistic cost and giving more boost to the fishing industry. It's again for good blessing. I think in income tax, they have reduced TCS tax collection source on the all overseas trip. Now I think we all can move more, and maybe tomorrow we in the European Union, if all goes well, even it will be visa on arrival. I think all good news from traveling and all comes. From indirect tax, they have brought completely new rules called a baggage rules, and everything will be through the app, which we call Atithi app. So no need to have physical documentation on. And second more good thing is, if today any personal baggage you bring, you pay duty at 20%. They have done a 50% reduction on that. So now whatever you bring, which is beyond your limit for an individual, and you want to declare, pay duty and bring into India, on all this good, standard rate will be 10%, BCD, not other duties. BCD will be 10%. Again, a good move where all people traveling, coming back will have the relevant benefit. Again, one more things to boost, because now geopolitical issue is not in favor of any of the country. All are looking to tag the other each other. The SEZ, Special Economic Zone, has given one-time concessional benefit. Today, if any SEZ sails into Indian market, they are liable to equivalent to custom duty. So they are demotivated to sail within India. And indirectly, they are giving the even boost to domestic market, so that they should not get all benefits and exploiting the DTA industry, but looking to the unutilization of capacity of SEZ manufacturing units. Government will bring the guidelines where for specific industry, specific product or all product with specific rates, they will give one-time concessional with particular time zone so that they can sail in India at lower duty. A good move, but we should be cautious because otherwise non-SEZ units, which are DTA and others, will have an impact. NCCD, it's mostly from excise perspective. They have applied on all the gutka, chewing tobacco, jarda, gutkas and all. And again, also they have given relief on the point on the this one, our biogas under the CNG, which will be on the duty will be on the only CNG, excluding the biogas. Now coming to the rate change, I will not go into detail on each and every rate, but in brief, they have decided to give benefit to key sectors like aircraft, solar energy, lithium ion cell, for battery, for textile, where they reduce the component duty of inputs. Somewhere they have stopped the exemption or partial exemption where duty has been increased. In some sector, they have given the capital goods benefit like for nuclear power and other product. So in brief, rates have been changed, having impact, whether by increasing or decreasing on the specific sector. How these sectors evolve, how these sectors having impact, my colleague Mr. Ajay will go into deep sides, taken to forward. Now, I will take one more aspect here, again a major part of the budget, because they have taken a first kartavya is sustainable economic growth. All these initiatives of key incentives announced yesterday are part of the sustainable economic growth. And they have targeted specific sectors where India is lagging, or we need to grow or groom, looking to the Indian individual's health scenario or procurement scenario or is a geopolitical issue. If you can see the one picture is there, they have identified sectors, identified new schemes, and specific to sectors. Some are common, specifically for MSME, where they are connecting trade, is it bill discounting platform, trade receivable to GEM portal, which is a government e-marketplace. They have concentrated again on semiconductor. 2.0 is coming. They have increased the allotment for ECMS scheme, electronic component manufacturing scheme, where budget was 22K earlier, now make it to 40,000 crore, thus double they have done the budget. It's a good scheme where they want dependency on the imports reduced, especially on components. They've announced multiple chemical parks so that India have more chemical production. They've announced even the mega textile parks along with multiple schemes for textile, which is our labor intensive and major booster to our economy. Containers, ship containers. Today, all maximum containers are imported in India. It's like a complete iron box, but still we import. They have given 10,000 crore worth scheme where containers will be made in India and then whether it's used, consumed in India and all. Rare earth. One scheme came last year, CMR incentive scheme. Now they have given the complete combination of the 3 to 4 coastal areas, AP, Karnataka, Kerala, Andhra, to have a rare earth combination. If you see existing schemes, say increased allotment. They announced n number of new schemes. In existing, if you see left side, ISM 2.0, ECM has increased the rare earth. They have given the more concentration. They have given trade combination with the GEM portal. They have given the container manufacturing part, shipbuilding. They want a more ecosystem and all. In new scheme, they are concentrating on biopharma, biosimilars. They want clinical trials, 1,000 location to have clinical trials. They want specific institute to have. Allotment is 10,000 crore for next 5 years. Chemical parks are there. Container manufacturing, textile. You can see all sectors which they want to contribute are covered there. One more good thing, if you see one scheme is there, which is called a carbon capture, utilization, and storage. So how it works, specifically for power, steel, cement, there is more carbon CO2 issue. So this scheme will create the aspect where the CO2, whatever is taken is extracted and put down in the refining or renewable. So it does not impact the environment. And being in EU FTA deal, there is a carbon tax. So India wants people to be ready in next 5 years so that we do not have an issue of carbon credit or a carbon, more carbon so that we need to pay carbon tax. The scheme worth is 20,000 crore. For this year, 26-27, next financial year, they allotted around 650 crore initially, and then it will be used for. Just imagine the government concentration is not on the major aspect. They are going to minor aspect also. They are going to minute thing to ensure that each and every sector competes and grow and boost our Indian Make in India and use all the FTAs part we signed now. So that all from a indirect tax proposal and incentives. Now I will request my colleague Aditya to share more. For DT, even there is no change for individuals, but there are changes for corporates, for TDS, TCS rate and all. Over to you, Aditya.
Thank you. Thank you, Vineet. I'll share my screen once again. Yeah. So can you see my screen?
We can see your screen.
Yes, we can.
Okay.
Okay.
Thank you. So yes, this time the budget from a direct tax proposals, I wouldn't say the expectations were a lot, but it is a mixed book. It's a mixed basket. The finance minister has in fact proposed a lot of changes, but more on the corporate and the international tax side. Nothing much on the individuals, as we had seen the bracket of the tax getting expanded last time itself. So, to begin with, just a few accounting and administrative simplification measures that they've taken. As you know, you may be aware, there are certain standards that it's called ICDS, Income Computation Disclosure Standards, which define how the income should be computed, like how the index works for accounting purposes. At some cases, if there are differences, this leads to reconciliation requirements and alignment requirements. Now, the finance ministry has proposed to constitute a joint committee of the MCA and the CBDT so that these differences can be evened out and finally ICDS can get subsumed so that there are no requirement of maintaining dual accounts, one for tax, one for books, and the standards can be harmonized. So this is one relief for the large taxpayers. Now then, there has been an increase in the timelines for filing of revised returns. Currently, this is 31st of December of the after 9 months. That is 9 months from the end of the 31st of March. If you recall, it used to be a couple of years back. It used to be 31st March. That is 12 months, but it got reduced. Now, what they've done, they've restored it back to 12 months, but with a nominal fee of 1,000 or 5,000, depending on whether the total income is less than or more than 5 lakh rupees. One can still revise the returns, even if it's filed belated, but by the due date, I mean, by the 31st of December. Yeah. So revision can be done up to 31st March. Then there are some extensions granted for non-audit cases, business cases like, for example, partners in partner in a partnership firm, which does not require to get audited. For them, an extra month has been given, like the ones those who show professional income, like CAs, and who are not required to audit. They are filing IDR 3 or IDR 4 or trust IDR 7. These are non-audit cases which were earlier subject to the same due date of 31st July as individuals. Now they have 1 month extra till 31st August. This also takes care of the system overload that we witness at the end towards the fag end of the due dates. Now then, there is a form 15G, 15H for senior citizens or people below 60 years who do not have income which is taxable, and they can declare these forms to they used to declare this to mutual fund houses for not deducting taxes because they're not subject to tax. Now, instead of filing it with each separate mutual fund for each separate securities, one single form can be filed with the depository, and that will take care of all your investments from mutual fund or securities, interest from securities, or equities, dividend from equities. So this is like simplification of the compliances which were being repeated before. There is a requirement in case there is a provision here that if there is an assessment order on the taxpayer and he does not agree with the assessment order, there is a demand raised, he wants to go into appeal, then there is an internal instruction from the CBDT that one can go into appeal and get a stay on the demand if he pays 20% of the demand outstanding, and then the balance of the demand is stayed till the time of disposal of the first level appeals. This 20% has been reduced to 10%, having seen multiple cases where the demands were huge and they were highly contestable. So it gives an upfront relaxation to the taxpayers by not having to shell out 20% of the tax demand. It helps them save the working capital. If they can pay 10%, again, while this is an instruction and the officers are bound by it, officers can also reduce this on merits, but that's discretionary. Now, there used to be a provision earlier where employees' provident fund contribution used to get disallowed. if they were not paid by the statutory due date, which is the next month's 15th or 21st ESI and PF, even if they were paid before the due date of filing the returns of the employer. There used to be provisions before that, and there have been case laws before which said that as long as it is filed before the filing of due date of returns, that should be allowed. That position has been restored. So even if the employer delays in the payment of employee contribution of provident fund beyond the statutory due date under the PF Act, but makes sure he deposits by the due date of filing of his tax returns, he will be allowed a deduction in his income tax return for such contributions. We've seen in the income tax returns as evolved over the years, the form has now built in with many more disclosure requirements. One such key disclosure is for the crypto assets, the VDA. And to continue the government stress on disclosing assets which are in nature of crypto, it has brought in about a penalty of 200 per day in case there is a failure to report crypto transactions. And if there are incorrect reporting, then it could carry a penalty of 50,000 rupees. The government has now this time shifted its approach from penalty to late fees. A lot of non-compliances which were subject to penalties are being recategorized as late fees. Now, while it is a cost, whichever way you call it, what it does help is, on one hand, it could lead to a possibility of the taxpayer claiming it as a deductible expense because that's not a penalty, that's a late fee for regularizing the compliance. On the other hand, the flip side of it is that because this will be rule-based, a compliance-based, one has to mandatorily pay these late fees as you would do that even for late filing of income tax returns. If there's a late fee, one has to pay it, then file it. Similarly, for tax audit report, if there's a delay, one has to pay the late fee and then file it. Then many times we've seen non-residents or even other smaller taxpayers being subject to higher TDS on transactions. Many times that can be related to sale of an asset, where especially for non-resident, where the TDS is deducted on the gross proceeds and not on the capital gains. And one has to go to the department to get a lower TDS certificate in order that the buyer does not deduct at the higher rate, and he is not inconvenienced by claiming it as a refund while filing returns. Now, this process of obtaining nil or low TDS certificate has been made completely electronic and in a completely rule-based system. But obviously, since it's rule-based, it will be for smaller and simpler transactions. The larger taxpayers claiming to file it for complex M&A or complex transactions would still need to go to the manual route before the AO and obtain the lower TDS certificate. But for the simpler ones, this has been a great relief, especially for non-resident individuals, smaller taxpayers who can do it online with certainty. Now, as Vineet mentioned, there has been some rationalization on the TDS and TCS, and this is one chapter which has always had some changes or other in every budget. Last year there were sweeping changes in a host of sections. This year also there are some changes. One of them being TCS on foreign payment under LRS, where you make payment for medical, education, or overseas travel. That was earlier subject to 5 or 20% depending on the threshold, but now it's subject to a lower TCS of 2% and without any threshold limit. The objective was to capture those foreign transactions and even link it to your income return, which is in line with the government's policy of using data for better synchronization and better assessment. So more like a data mining. So I think government has already introduced higher TCS last time. The idea was to get these transactions on board. Now that they are on board, it is reduced, having got representations from various sections of the society. And now the TCS rate stands at 2%. These TCS gets credited in your account and you are able to view that the taxpayer is able to view this in his 26AS, and like any TDS, he is able to claim it while filing the tax returns. Another contentious issue was manpower supply, which was having some long-standing disputes. While some claimed it being in the nature of professional services, hence subject to TDS of 10%, there were many contentions of this getting subject to 1 to 2%. Now this has been clarified, putting to rest a lot of controversies and litigation that manpower supply services will be subject to TDS of 1 to 2%. Another relief is on the interest, that is on interest on delay for reward of the accident compensation by the tribunal. If there is a road accident and goes to tribunal, and that provides the victim or the legal aid of the victim with any compensation. Many times there's a delay in the release of the compensation, and the interest on such delay used to be earlier subject to TDS, causing further agony to the victims of the legal error. This has now been fully exempt. Without any leakages, the entire amount should be paid to the bank account of the victims of the legal errors, as the case may be. One simplification has been a much awaited one. This is on the purchase of property from an NRI, wherein resident individual or HUF buys a property from an NRI. He used to earlier require to obtain a TAN and file the returns. Now it's made similar to in line with how 194 IA works for removal property purchase, where you can just have one PAN-based challan for the purchase of immovable property and comply with the TDS requirements rather than the buyer having to obtain TAN. While we say this has been a much awaited relief, one provision which I come across many people being unaware of it is that many times the landlords who are non-resident and the tenants paying rent to them do not deduct TDS on that, but there is actually a TDS under residuary provisions of a higher rate of 30%, and which comes with the requirement of the tenant obtaining TAN number, filing TDS returns for the TDS deducted on the payment of rent. That remains as it is. There's no change, unfortunately, on that. Only the purchase of property from NRI has been allowed to be more convenient now for the buyers. Now, there have been some changes on the assessment reassessment front. We used to earlier have assessment orders and separate penalty proceedings as well, which was emanating out of disallowances, adjustments made in the assessment or reassessment orders. So that used to lead to two separate proceedings: one, the regular assessment or the reassessment, other the penalty proceedings. Now, having realized that it leads to a lot of wastage of efforts, wastage of time, duplicacy of efforts. Now this has been integrated. The same order would cater to penalty and assessment, and it also syncs with the overall idea of easing the business, the ease of doing business for the taxpayers. Then comes the immunity for penalties. So penalties generally can be raised, can be levied by the officer for either misreporting or for underreporting. While underreporting has a penalty clause of 50% of the tax evaded, the misreporting has a clause of 200% of tax. Now, in the current Act 1961, the provisions so exist is there is an immunity provision 270AA, which allows the taxpayer to settle with the tax officer or buy peace with the tax officer if he decides not to appeal against the adjustments made in the order, and he pays the demand as well as the penalty. But that is not applicable for the misreporting cases where you have 200% of the tax evaded. Even if you are paying it, or even if you're not appealing it, there is no immunity granted. Now, if one pays 100% of that is half of the penalty leviable, and does not go into appeal, he can also seek immunity from penalty for misreporting cases. There have been some cases in past we've seen where the DIN was not mentioned on the order, and the entire proceedings got quashed because of that. Now this has been addressed. This has been addressed in the new amendment, where it said even if the DIN is not mentioned in the order, but it has been communicated through one way or the other, or the order has a reference through some computer generated DIN, that should be fine, because the it's not an order which is not it's not an order which is not in which is not having any reference on the in the computer records. The updated returns facility, as you know, was introduced a couple of years, around 3 years back. Now that has been extended to cases which has been subject to reassessment. Earlier, it was not permitted once a reassessment notice was issued to file updated returns. Now, during the reassessment proceedings, even if the notice is issued, the taxpayer or the SSE can file an updated returns by paying an additional 10% of the tax and the interest on such additional income, and he also gets an immunity from penalty on such additional income disclosure. So this is another step on getting certainty on assessments and reducing the litigation. Now, there have been some provisions where the decriminalization. So this has been the, I would say, this has been the steps taken not just in this year. Even before, there have been some provisions which were decriminalized, where the imprisonment requirement were removed for defaults in TDS and TCS earlier. Now, in continuation of those efforts, the decriminalization on certain lapses have been reduced. The maximum is now 2 years instead of 7 years. And for technical lapses like failing to get the account audited, those things have been decriminalized, and instead only a fee has been proposed. One, for now, moving to the corporate and international taxation, one key change this time, and this is to further incentivize or in one way push most SSEs to opt for the new regime, um, which is in intent of the government to have the SSEs go for simpler tax regime with lesser tax rate and no deduction or lesser deductions. So, in line with that, the MAT credit now will be, whichever is accumulated, will now be able to be utilized for only companies from 1st April 2026 which go for new regime. If they continue in the old regime, the MAT credit would not be, they would not be able to utilize the MAT credit. It will lapse, and MAT will also be considered as the final rate. That is, if the company is in an old regime after 1st April 2026, and it has a MAT liability, the MAT that it pays does not add to its MAT credit balance, and it is not offsettable in future against in a year in which it has normal provisions, normal tax liability. The MAT though has been reduced from 15 to 14, but the intent of the government is to incentivize companies to move from old regime to the new regime of 22% rate, which effectively boils to 25.17% tax rate, corporate tax rate, after inclusion of surcharge and cess. There's been one change in buyback also, which is significant. And in fact, this buyback has been at the center of a lot of changes in the last 4 or 5 years, with multiple changes. One being, earlier it used to be in the hands of the company as a dividend distribution. Then it came up to be in the hands of the shareholder as a dividend. So currently, the buyback proceeds are being taxed as deemed dividend in the hands of the shareholders, and the cost of the asset is allowed to the shareholder as a capital loss to be offsettable against the capital gains. But now the things have simplified. The buyback is now back to be taxed as income under the head capital gains for the shareholders, and that will be taxed. But there are different rates prescribed. While it's a capital gain, so the long-term capital gains rate of 2.5% will apply for long-term assets, and short-term assets will be as per slab or for listed 20%. So the promoters still have had to, there's a kind of anti-abuse tax for the promoters where they will end up paying almost equal to the slab rates which they are paying now if they have to buy back. And promoters have been defined to be the same as it is defined in SEBI for listed companies and Companies Act for the unlisted companies, which is like holding more than 10% and holding control over the companies. If there is a promoter which is subscribing to a buyback by the company, then the tax rate continues to be 22% and 30% plus the surcharge and cess. If it's minority shareholders like in listed companies, small shareholders, there we would only have the capital gains tax rate, which is 2.5% or 20%, depending on long term or short term. A tax holiday, 10-year tax holiday has been proposed for foreign companies which are providing cloud services via India data centers. This is in line with government's focus to incentivize more of data centers, having realized and having also touched upon in the earlier section by Vineet and for the economic survey. Foreign assets. So there is a one-time window granted now for taxpayers who who have certain foreign assets and have not been disclosed in their tax return so far. While the government has notified the forms in the scheme, it will largely be for income and assets less than 1 CR. The tax will be 30% plus 30% additional on this disclosure, so around 60% tax. But the major part of this is it will grant them relief from the Black Money Act, and there will be no penalty on such once such asset is disclosed. This could be critical for many employees of the companies who are seconded and who who are seconded and who get ESOPs during their tenure outside India, and then when they come back to India, they have forgotten to disclose those ESOP. And now there's a window for them to disclose this from 1st April to 30th September. Details of the scheme will be notified on this. Now, there's one critical change in the transfer pricing on the transfer pricing front. A lot of the captive service providers, the GCCs, the IT and ITS, which are the plethora and which is like the major service sector for India, and Hyderabad is one of the key markets for them. They used to earlier have safe harbor for a limited turnover threshold of 300 CR and for limited set of services like the IT and the ITS in the range of 17 to 18%. For KPOs, it used to be slightly higher, and same for contract R&D. Now, the government has tried to bring in all similar services, IT and other similar services to IT, like the IT, the ITES, that's the support, the call centers, the KPOs, the contract R&D for IT. All these services have been brought under one basket, and a new safe harbor rate of 15.5% on the cost has been provided, which means that suppose if there is a GCC of McDonald's in Hyderabad, and it provides services completely to its overseas parent. Now, on the entire cost, operating cost that it incurs, if it charges 15.5% as a margin and then bills the parent, it is eligible to opt for a safe harbor as long as the threshold is within 2,000 crores. And once it opts and it's accepted, this provides certainty on the transfer pricing, because otherwise transfer pricing can lead to huge demands and a lot of uncertainty. And to add to it, it also leads to leakages within the group, because by the time the transfer pricing assessment gets concluded in India, and if there is an adjustment, the other side, which is the service recipient in US, does not get a corresponding expenditure because their books are already closed. So it's a overall hit to the group, where one's income is not offset, not while the one's income in India is taxed, but the expense is not given relief by the other country. Now, further on the data center thing, this rate of 15.5% of safe harbor is even been proposed to be lower at 15%. So if there are Indian corporate data centers providing services to its overseas related parties, or the associated enterprise, as we call it in transfer pricing jargon, which in turn provides cloud services to its customer outside of India, such Indian corporate data centers can opt for the safe harbor transfer pricing net margins of 15% on cost, and have certainty on transfer pricing litigation and acceptability. Another change has been on the unilateral APAs. We've had some breakthrough unilateral APAs as well as bilateral APAs in India, especially for the IT sector over the last several years. but the average time for turning around for closing an APA, even a unilateral Indian APA, has been in excess of 4 years. And it's not just India; that's been an average pretty much globally. In fact, there are countries like Australia and in Europe, which is even taken more than that. So now that there has been some experience with India for more than a decade on the APA, especially on the IT services, and there is an expertise built with the department as well. The government wants to fast track this and keep the time limit for conclusion of these APS. They would endeavor to do it within 2 years with an additional time of 6 months only at the behest of the taxpayer. So this is a welcome relief if we can have 2 years APA, which can provide you certainty on the transfer pricing margins or the transfer on the related party transaction for 5 years forward and 4 years back. Within a period of 2 years, it provides a great deal of certainty for the foreign MNCs who are in India. And sadly, though, there is no announcement on the BEPS Pillar 2 rules in India, which means an Indian headquartered company having global operations, especially in Europe, which has adopted BEPS Pillar 2, will still not allow to file the BEPS GIL returns in India. They will still have to file it in a jurisdiction like one of the EU jurisdictions or some other countries which has adopted Pillar 2. That means they will be having to file the entire group's details as per the Pillar 2 requirements in a country outside of the headquarters. Now, there are exemptions which have been granted to data center services for income which are arising or accruing in India from the customers. So basically, if from the customers relating to procuring of notified data centers in India. So if there are customers who are outside of India and the company is providing data center cloud services to them by procuring these data center services from India, then those foreign countries will be allowed exemptions until 2047, which is like the year of the Amrit Kal, 100 years from the independence that the government has kept. As long as if the services are provided to Indian users, then the tax holiday would apply only when such services are being provided through an Indian reseller. That is an Indian company, not the foreign company. So the impetus is on the Indian company also being set up for providing the services when it's being provided to a local country. uh, like Vineet was mentioning, critical minerals, even income tax, there are the expenses which are required to be incurred for exploration and mining of these, in exploration of these minerals, are allowed as a deferral for the period of almost 4 to 5 years from the commercial production. This list of critical minerals have been expanded to include various other minerals. There is an exemption on 5 year for foreign experts on the foreign income related to providing on the income of foreign company for providing capital goods, equipments, tools to its Indian contract manufacturers located in custom bonded warehouse, where the Indian contract manufactures it on behalf of the foreign company. Any income that it derives any income that the foreign company derives by providing such capital goods and equipment or tools to the Indian contract manufacturer would be exempt till 31st of March 2031, and it also takes care of the PE exposures that the foreign company would have. While this is the last amendment, which is not specifically on the direct tax, but I thought it's a key one, which is an amendment to the Black Money Act, where it says there's no more prosecution where the foreign asset, which is not in the nature of movable asset, it's a non-immovable asset. If such foreign asset is less than 20 lakhs, then the draconian prosecution provisions will not apply under the Black Money Act. So these were the key direct tax proposals. I am done with it. Vineet, should I stop sharing the
Thanks,
screen?
Aditya, and thanks for sharing your insight. Yes, we can understand, and obviously we will take Q&A on the multiple aspect, which from direct tax, indirect tax, and other part. Before that, I will request Mr. Ajay to share the insight on the capital market, how this budget, as we all know from what happened yesterday and today, we would like to know more insights, how the market behaves based on budget and how all industry sectors which will have impact, and what's your view on that? Over to Ajay ji.
Thank you, Vinit ji, and such a good platform to understand the things about the budget. Yesterday, we have seen uh, things was been quite challenging for Indian market. As we know, since last 1 year, Donald Trump, as soon as taken a post at US, we have seen the tariff war. One side we have seen geopolitical tensions for there. Then Donald Trump was back to back. We have seen tariff concerns was be there. In fact, we were expecting after Donald Trump victory, it would be supportive for Indian market, but things were on toss after we have seen the duty was one of the highest duty we have seen. I hope my screen is visible.
It's
So
visible,
almost
Ajay ji. It's visible, Ajay ji. It's visible. It's moving also.
so last year was a tremendous big blow for Indian market. We have seen rupee has depreciated very sharply. Today I'm just sharing a presentation. It's just for educational purpose. So almost everything has been covered. Like we have seen the higher growth rate, which suggests that India is still very well, but no doubt we Indians have some more expectation from our FM. But frankly, from my point of view, we should rate around 8, 8.5 because giving international scenario, what we have seen right now has never been seen in last 5 to 10 years back. Because today we have witnessed almost 6 to 7 war in last 3 years. Inflations are on toss in global market, whereas we are been slightly insulated. Here we have seen food inflation going in negative also. Things are being going great in India as we are moving from unstructured to structured economy, which is going to be more important because in 10 years, 12 years back, there was certain unaccountability in accounting and everything, but now things have been in light that can be easily watchful from GST number and other. So coming back on the economic vision, we have seen government has make sure that domestic manufacturing capacity should be reviewed again. That will definitely boost Make in India project. Energy security is most important, and we have seen in last certain period that our import bills are more about crude oil, but in last 5 years things has been changed. We have been continuously diversing to renewable energy or bio fuel. We can say ethanol policies has been came in picture. Reduce the critical import dependency. Citizen benefit from government action. Far-reaching structural reforms, strong public investment, monetary stability. Even rupee has depreciated. IMF has criticized that India is manipulating the currency, but frankly, we have seen in case of China also since 2016, China is devaluing their currency. Even last week, Donald Trump has given a statement that if dollar comes down, that is nothing big deal because still dollar is been slightly higher as compared to other exporting countries. So I think rupee depreciation is a new term where I think it will continue to be there. Easily we can head, we are heading towards 95, 96 zone because this will definitely restrict our imports. But on the contra, our exports are slightly steady. No doubt concerns are there for FIs, but I think FIs are coming, but with an opportunity fund. We need a structure fund that could long last in India, but that need to be seen by government. So government has came out with a first Kartavya, accelerating the sustainability, economic growth, enhancing the productivity. Second Kartavya was fulfilling the people's aspiration by building the capacity and making them partner in prosperity. Third Kartavya was the vision for Sabka Saath, Sabka Vikas, and we have seen things have been that. See, India is geographically a very big country, so things get time to adjust. So overall, India reform was still going on with a 7%. Over 350 reforms has been rolled out including GST notification for codes and conduct and everything. Central government is working with the state government to remotely deregulating. Pillar of growth would be sustained economic growth, uh, excellent development, GST simplifications are still going on, trust-based governance, ease of doing business. All this part has been already been taken. But from the sectorial and industrial announcement, government focus comes at manufacturing, where we have seen focus are still going on for semiconductor because 40 years back the fight in global market was for oil. Those economies having a good reserve of oil would be the king, but now we are in digital age and country having a rare earth metal or semiconductor would be the clear winner. The government focus on rare earth metal, semiconductor still have been seen in budget 26. MSME champion, or we can say chemical, container, textile, means small and small industry has been taken care in this budget. From service and skill set also government is very much we can say focused, where medical tourism is been important factor. Just a minute. So medical tourism, or we can say education side, Yuva Shakti even is been focused. So I think government is doing its best, but let's see how the individual sectors would be moving. Like from infrastructure, because as long as Indian government is focusing on infra fund, definitely growth would be continue to be there. So I think we are more bullish on infrastructure as new rail routes. 7 high-speed rail corridor has been announced. Logistically is most important because in agriculture we see generally after harvesting the storage capacity is very poor in India. Logistic issue has been there and processing issue has been there. The government has focused on that also, biogas, or we can say energy transmission, nuclear power. From the financial sector, high level committee for banking and financial hub system has been going on. Then STT is a slightly a setback, but we can say there was a term called syntax. Syntax we have seen from tobacco industry. One side government is trying to punish those who are a consumer to stay away from this type of scene activity, but other side government need money also to raise. So we will be seeing STT what will be the impact in next slide. But here agriculture and allied sector is going to be more important because Bharat Vistar, that is agriculture stake portal would be there. Much of the data as of now from agriculture point of view, we don't have many data ready right now as of now, but slowly and steadily things are being focused on that. Fishery, where integrated development work would be there. High value agriculture like coconut, cocoa, cashew nut has been focused, even sandalwood. uh, so I think things have been balanced as of now. From the fiscal matter, we have already seen important, as I have already placed that looking to the global market scenario, still we are estimating 4.3 fiscal deficit. That is a good thing. Capex outlay is still going on that target. Even we can say the expenditure, the major 46% that has been given is top five sector, which is transport, defense, rural development, home affair, and agriculture are 5 6 sectors which are been still in focus for government. Coming on STT, definitely government will make sure because of speculation which are going on in last after post COVID, things has been totally changed for capital market. Here earlier the future market was having a taxation of 0.02%. Now it's revised to 0.05. Option has increased, excising of option has increased. This will definitely reduce the speculation activity in capital market and boost the commodity market, because we have already seen commodity market, gold and silver or even other participation are now moving on commodity, where mutual fund came out with a multi-asset focus have been going on. So key takeaways, definitely arbitrage fund returns would be slightly impacting because of higher STT, but overall I think going on. Coming on the sector, like first of all, we are looking for metal and mining sector, which is going to be positive after this announcement. Like capital expenditures announcement for financial 27 is around 12.2 trillion. Government has already announced these 7 high-speed rail corridor. Even important is the steel silos, which is used for keeping the food grains intact. So up till now, we have seen this type of things has been not been taken care. Either government is taking care, but there was small incentive for public-private partnership. But now I have been in touch with many companies who are in this steel silo business. But I think there is a good scope over here. Coal exploration, or we can say rare earth government is focusing on stocks. Some stocks are being given like steel, steel, Tata Steel would be benefiting from here because regular consumption would be there. From the IT, definitely important would be agriculture mission, where AgriStack rollout has been there because we have almost more than 60% of our population which is not in India, that is in Bharat. Even I used to say in my all of my seminar and all that now money is not in India, money is in Bharat. So everyone has to focus on tier 2, tier 3 city, and government is making same thing. Higher outlay has been for digital governance has been going on. So I think the overall scope for IT is going to be very good. No doubt, US, Europe is slightly under pressure right now. It will take time, couple of at least I think the uncertainty would be continue to be there for our US and Europe. But domestic consumption or domestic digitalization is going to be improving from 26, 27. So I am more bullish on domestic consumption of IT sector, where TCS, Infosys, and other sector would be definitely getting benefited. Building material, because now modernization are going on for tier 2, tier 3 city. You can see many big players like Godrej or Lod are now moving to the second 2 tier 3 tier cities where scopes are being quite good. Even one term 2 years back I was focusing was temple economy, and we can see this time also government has clearly mentioned temple towns. So I think with the growth of temple town, or we can say temple economy, is going to be a big boost as an investment also. Generally when we talk about temple economy, it's not only a temple but the infrastructure that has been built near to temple. It could be road, it could be hotel, or we can say tourism, temple tourism. So I think that could be more important because 5,000 crore per city as a economy region over 5 years has proposed. That is a big deal. So I think Bharat is going to be a big consumer for that. Some key stocks which are been related to infrastructure has to be keep in focus. Now last would be the capital goods, is as usual because we India have a youngest population, and definitely as our income is rising, the consumptions are heavily increasing day by day. There was a data last couple of months back I have presented in Spice seminar. One is the rise of dark store, which is not mentioned in this PPT, but just think over that. This is same as we have seen in 2001, 2002 when there was a rise of mall culture in India. Right now, 5 years back, there was hardly 10, 12 dark stores available in India, but now it's around 6,000 plus dark store. That means that this is a artificial demand that has been created in the market. So I'm more bullish on capital goods, or we can say FMCG product, because what is happening with the every rise of dark store will create a new demand, which will be artificial demand, not an actual consumption demand. So company will be showing their sales are rising, but ultimately dark store will consume the same. And second data is CAIT's marriages data. Before COVID, we used to have around 20 to 23 lakh marriages, but last year, as per CAIT, it was around 56 lakh marriages. Because in India right now, marriages are been we can say treat as a important trigger for any domestic consumption also, because we have horeca industry, we have every industry has been we can say impacted by the marriages. So I think with a young population, these two data is more important. One is dark store rising, and other is CAIT marriages in India. And 2026-27 is going to be again a bigger size of marriages, and which could be around, I think if I am not wrong, 6.5 lakh crore businesses can be achievable. So I think uh, demand would be continue to be there. Coming on slightly to couple of slide on commodity, where we have seen a crash in bullion. It's not a crash, we can say, because we have seen 125% gain in gold prices. Gold prices couple of years back was trading, or we can say around September 2022, gold prices was near to 48,000, or let's say 50,000, and made a high of 1 lakh 80,000. See, up till now in India, we have never bought gold. We have consumed gold. But now people has understand, whenever there is a Black Friday, Black Tuesday, Black Friday, Black Monday, equity equity market crash down, then definitely gold will be on positive side. So in last couple of years, we have found that financial money has been poured in commodity also, or we can say financialization of commodity has been started. So this is just a start of commodity as an investment, because today whenever we ask any investor that have you invested in commodity, only two things comes in a mind is gold and silver. But there are many commodity that can be invested like base metal. Last year, Vedanta's owner, Mr. Agarwal, has told that copper is a new gold, and we have seen copper prices went on a toss of around 72%. And now agriculture commodity is the next big thing. I think in next couple of years, we will see agri as an investment, other commodity as an investment. So I think things have been good for commodity. This chart is very important and very crucial in last 50 years. What I have done, I have taken S&P GSCI index, which is Goldman Sachs commodity index versus S&P 500, which gives me a trigger point, because whenever this ratio is closer to 1, just a minute. Huh. In 1970, the index was around 1.5. And whenever this ratio goes up, that means there will be a crash in equity and commodity will outperform. It could be in the year of 1985, 86, where we have seen it has went up and we have seen a correction in equity market, or dot-com bubble. We have seen after that market, equity market has corrected, or 2007, 2008, 9. Here also the financial crisis. But the common thing all this was crude oil. Like in 1980, oil crisis, Gulf crisis was actually oil fight. In 2008, there was a financial crisis. I think everyone agree that this is a financial crisis. But my conclusion is it's not a financial crisis. It was a part of crude also, because on 20th of Feb 2008, crude prices was around $150. That means with every rise in this ratio, crude is a part, and now this ratio is around 0.6 and mean is around 3.81, which suggests in next couple of years at least this index should come up. See, near to COVID, we were expecting this ratio should go up, but this ratio has maintained a linear move, because one side Indian economy, or we can say global economy, was pushing liquidity in equity market, and that is why we have seen equity market has performed and commodity market has performed. But frankly, in next couple of years, I am expecting a sharp jump in this ratio, which suggests commodity has to go double from here, or equity has to crash. Let it be, it could be the reason Donald Trump, or it could be a slowdown recession, but this ratio since last 50 years has never gone wrong. So slightly be cautious on equity market. And last, this is a new index which we used to track every time. That is US uncertainty index, which or global economy policy uncertainty. You can see in last couple of months from mid of December, this index has started moving lower side, and that is why we have seen commodity market has started correcting. So whenever uncertainty comes down, immediately it will impact crude oil prices and gold prices, and we have seen a correction because that was a leading indicator, we can say, we call as EPU impact. So I think uncertainty is still there with the Donald Trump, but it has been reduced. So I think commodity market and equity market, we are more bullish on commodity still in 2026, but phase by phase manner. But equity is going to be in a linear way. Some or other sector would be going on, like metal sector looks good, capital, we can say capital market, financial market will perform, but be specific on stock and sector. That's all from my side. Thank you.
Thanks, Ajay ji. Thank you so much. And now we will take a Q&A session. We received certain queries, and if anyone have other query, they can raise the hand. So Aditya, Jairaj, Suresh, and all the I will start with two queries first from Direct Tax. As you all know, this data center changes happened mainly because there was a push from one of the alliance partner, Mr. Naidu, because Visakhapatnam is now a major data center hub after multiple people announced the new venture. So can you give example, Aditya, how the scheme will work, or whether it's only applicable to foreign companies or even the domestic company can structure transition to take the income tax benefit. Aditya? Aditya, you need to unmute.
Yeah. I've unmuted myself. So this tax holiday till the 31st March 2047 that they've given is these are to provided to the foreign companies, and these are provided to foreign companies backed on the usage of the data that they are going to use from the data centers in India. So these foreign companies are going to set up their data centers in India, like you said, the alliance partners in Visakhapatnam. So they're going to set up the data centers in India. They're going to use that data to serve their customers outside of India, provide them cloud services, but the data centers are going to be in India. For them, these foreign companies will be incentivized to come because they won't have to pay taxes now for these services as long as these are not being consumed by the Indian users. If they are being used by the Indian users, these cloud services, then you provide it to an Indian subsidiary of yours. You see, and then the Indian subsidiary will get that exemption like that. We'll get the more details. I think it will be notified. The notification has to be done. Yeah.
There will be two arms which will get benefit, correct? One is Indian arm and one is the foreign arm.
Yeah. So for the Indian users of the cloud services, it has to be through the Indian subsidiary. Or for the overseas customers who use their cloud services, the foreign company, obviously that generally the foreign company, the US companies or the other companies who will be providing them cloud services, they will be getting exemption on the income that they make out of the cloud providing cloud services to their foreign customers, as long as the data centers are in India, they are being used to provide these services. And it also takes care of the PE and all. Otherwise, it could also lead to a PE exposure for having an infrastructure in India and controlled in India. So because it's exempt now under the scheme, so it doesn't, obviously there's no PE, then that has been clarified. So there's a certainty now for them to come and set up their data centers in India, certainty from litigation and relief from taxes.
One more query again for you. Ajayji, you have one more query. I will come back to you. Give me 10 minutes. So one is on the supply of capital goods for electronic industry in the bonded area for tool manufacturing. The question is, what all electronic goods or finished products are eligible under this sector, and how it will work, because tool manufacturing will happen in India and the bonded area, and the foreign company who is sitting outside India supplying to India, how that company will be taxable under the Indian regime.
So the foreign company here would be providing, their tools, their capital equipment to enable these, Indian contract manufacturers to manufacture the electronic equipments, right? For them, supplying to an Indian resident would be considered as a source which lies in India because they are earning income out of supply which are made to an Indian user, Indian consumer, and hence those income could be subject to tax. Now, on that, the exemption has been provided. There's no tax that you would get, and obviously that also again brings the clarity on the P front. There's no P exposure that you have, and about the kind of electronics that would be included. I think these electronic these electronic products would be, if I'm not wrong, would be under that scheme of MEIT of that.
There is always a slip between cup and a lip, and which is evident year after year. When we talk about from the IT sector perspective, the internship, what government is thought about in manufacture and innovative industry as such, there's a miss on that mark too. However, the way I understand from Vinitji, Ajayji, Adityaji from you is, this budget seems to be a very good budget for the IT industry per se compared to last one, because in US we are facing tremendous headwind because of the visa problems. The EU is getting open up for us, the EU per se, so which will have major deals happening. So that is a tailwind which we are hoping for. And with this, the simplification what government has brought in, the unified classification for multiple services, which actually makes us to focus on the business and not to worry about too much procedure orientation. So that's a good thing for us from the IT side. And before we go for a formal vote of thanks and complete the question and answer session, Jairaj, you are saying something?
I have a question for Mr. Ajay. Uh, Mr. Ajay, you are there. What is it you are looking forward to have, the semiconductor which Government of India has already targeted Odisha as the hub where the wafers will be manufactured. So what do you think that, when the government of when the Odisha will produce and deliver the wafers? Because that is what because you are there looking towards a commodity market. Silicon is also one of the commodity. What I don't know whether the silicon is being traded or not.
So silicon is not traded. So we have very limited on future side commodity, that is around right now around 20-25 commodities being traded, with is agri and non-agri. But I think, see, whatever the schemes up till now we have seen, like semiconductor or chemical, bio, textile, this will open up. We can say this will open market actually for future market, because whenever there is a volatility, any corporate need for hedging. Up till now, government has never focused on the hedging perspective, because for any MSME or corporate, important is raw material profit margin, then overhead expense, because no one can change the sale price. But if he can continue to hedge or fix the raw material, automatically their expenses and their profit margin would be, we can say, fixed. So I think there is good scope in commodity market, and as government is also now focusing on semiconductor and many new sector which are opening up, which will definitely boost the commodity market.
Thank you.
We will take one more last question. I think that I need to answer. Question is regarding AEO, whether who is eligible import manufacturer. The response is till now they yet to identify how will they decide which one is eligible. Because like for a PSU, anyone is PSU, they are eligible. So it's very simple way to go ahead. But for a manufacturer importer, who all will be eligible, which sector will be eligible, they will come out with a specific definition and guidelines. So that all from our side, and thanks everyone to join the session. I will request now Krishna Minty to take it forward. Over to you, Krishna Minty.
Yes, thank you, Vinit sir. So I got one question from audience side. So
Yeah, please, we can take it. No issue.
yeah, does this budget give any benefit for home loan EMI or housing related planning?
Aditya can answer.
No,
Aditya?
no. Unfortunately, there's nothing in it for any individual. It still remains status quo as it was last time. Only thing that was mentioned in the budget space was a simplification of the tax returns that will be notified after 1st April 2026. And maybe more voluminous data pulling in the 26 AS or AIS to enable you to pre-fill the returns easily. But nothing else on the individual front. To be specific, no to home loans and all. No specific change.
Okay, thank you, sir.
Any other question we have, Vinti, or we can conclude the session?
Yeah, we can conclude this.
You can give vote of thanks and we can close now.
Yes. So on behalf of Sailotech, I would like to sincerely thank all our speakers for sharing their expertise and insights today. So your perspectives on Budget 2026 have been extremely valuable. And I would also like to thank all participants for joining us in the session, and we hope you find it informative and useful. And thank you once again, and we look forward to